of Management Studies IGNOU presents an audiobook on the course MMPC 003 Business Environment for MBA program. Presenting Block 2 Overview of Indian Economy, Unit 5 Indian Financial System Part 2. Reserve Bank of India. RBI is an apex bank of the country and acts as the regulator of the financial and monetary system in the country. It was established after the recommendation of the Hilton-Young Commission. It was established as a banker to the central government by the Reserve Bank of India Act 1934, and it began its operations from April 1935 as a private shareholders bank with the paid-up capital of Rs 5 crore, and in 1949, RBI was nationalized. Functions of the RBI. Some of the major functions of RBI are: Number 1, Note Issuing Authority. Number 2, Banker to the banks. Number 3, Banker of the Government and Debt Manager. Number 4, Banking Sector Regulator. Number 5, Foreign Exchange Manager. Number 6, Maintaining Financial Stability. Number 7, Development Role. And number 8, Regulator of the Monetary Policy. Note Issuing Authority. RBI has a monopoly over note issuing in India other than 1 rupee notes or coins and coins of smaller denomination. RBI ensures that both currency notes and coins are available in an adequate amount in the country. The currency notes issued by RBI are legal tender in the length and breadth of the country. RBI can issue currency notes up to the denomination of Rs 10,000. At present, notes in the denomination of Rs 2, Rs 5, Rs 10, Rs 20, Rs 50, Rs 100, Rs 200, Rs 500 and Rs 2000 are issued. Similarly, coins in circulation comprise Rupee 1, Rs 2, Rs 5 and Rs 10. Banker to the banks. All the banks in the country have an account in the RBI via which banks settle interbank transaction and customer transactions. It also enables banks in maintaining statutory reserve requirements like statutory liquidity ratios, that is SLR, and act as lender of the last resort. It also provides short-term loans and advances to banks as and when the need arises. Banker of the Government and Debt Manager. RBI acts as a banker to the central government of the country along with those state governments which have agreed with RBI. It maintains the government accounts and does financial transaction from this account along with the transfer of government funds. It manages the government domestic debt and raises the money both from the public and financial market to bridge the shortcoming of revenue. Banking Sector Regulator. RBI regulates and supervises the banking system of the country in accordance with the various provisions of the RBI Act and Banking Regulation Act. RBI as a regulator does a wide range of activities like providing licenses, prescribing capital requirement like capital adequacy norms, paid-up capital, and lending to the priority sectors of the economy like farmers, women, etc. Regulation of interest rate and inspection of the banks and bank branches, setting of different regulatory norms, and also to initiate new regulation in accordance to changing circumstances. Foreign Exchange Manager. As you are aware, the trade is very essential for any economy. For conducting trade, adequate stock of foreign exchange reserves are an important requirement. RBI plays an important role in both the development and regulation of the foreign exchange market. It regulates the transactions which are related to both exports and imports and ensures smooth conduct in the domestic foreign exchange market. It is the custodian of foreign exchange reserves and the gold reserves of the country. The banks and selective institutions which wish to deal in the foreign exchange need to have a license from RBI. Development Role. RBI aims at promoting financial literacy and education among the public and also ensures that credit is available to the productive sectors of the economy. For the development purpose, RBI has established many institutions like the National Bank for Reconstruction and Rural Development, that is NABARD, Unit Trust of India, that is UTI, Deposit Insurance and Credit Guarantee Corporation, Industrial Development Bank of India, that is ITBI, among others. Regulator of Monetary Policy. Monetary policy is the policy of RBI through which it regulates the financial market of the country, and most importantly, it is used for credit control. Credit creation is one of the chief functions of the bank. Before we move forward, let us try to understand what is credit creation. Whenever the bank accepts a deposit from the customer, it retains some proportion which is mandatory of this deposit for the requirement of the depositor, and the rest is given as a loan to the buyer. So bank creates money out of money, and this process is called credit creation. It is through credit creation that money flows into the system. However, both the excess and deficiency of money circulation is damaging for the economy. If the supply of money is more than the demand, then we have the problem of inflation, which you have learned in the previous units. In contrast, if the money supply is less than demand, then we have the problem of deflation. So RBI uses monetary policy to control credit. Methods adopted by RBI for credit control are classified as quantitative and qualitative. Let us discuss these methods in detail. Quantitative methods. Quantitative methods are used to control total quantity or volume and the cost of the credit created by banks. Within quantitative methods, we have direct and indirect instruments like cash reserve ratio (CRR), statutory liquidity ratio (SLR), and refinance facilities are direct tools. Bank rate, repo rate, and reverse repo rate, liquidity adjustment facility, that is LAF, open market operations, market stabilization scheme, that is MSS, and marginal standing facility, that is MSF, are indirect instruments. Cash reserve ratio or CRR. It is the minimum amount that banks keep with RBI as a proportion of their net demand and time liabilities. The CRR percentage is notified from time to time by RBI. CRR ensures that banks have sufficient cash for the depositors' requirement. Statutory liquidity ratio, that is SLR. It is the percentage of NDTL, that is net demand and time liabilities, that banks have to mandatorily maintain in safe and liquid assets like cash, gold, or government securities. SLR restricts the expansion of bank credit, increases banks' participation in the security markets, especially government securities, and it also ensures the solvency of banks. Refinance facility. This facility is used by RBI to provide adequate credit to selective sectors like the export sector. Bank rate policy. According to RBI Act 1934, a bank rate is the standard rate at which RBI is prepared to buy or rediscount bills of exchange or other commercial paper eligible for purchase under this Act. The bank rate has been aligned to the marginal standing facility, that is MSF, and it changes automatically when MSF changes. Repo rate. It is the rate at which RBI lends to the banks overnight against the collateral of government and other approved securities under the arrangement of Liquidity Adjustment Facility, that is LAF. In simple terms, it is the fixed interest rate at which bank borrows from RBI for the short term. At present, Monetary Policy Committee, that is MPC, decides this policy rate along with the reverse repo rate. Reverse repo rate. It is a fixed interest rate at which RBI borrows from the banks in order to absorb liquidity for the short term or overnight basis. RBI borrows against the collateral of eligible government securities under the LAF. Liquidity Adjustment Facility or LAF. This facility was introduced by RBI after it was suggested by the Narasimhan Committee on Banking Sector Reforms of 1998. It is a mechanism for managing the liquidity needs of the bank. It aims to inject or absorb liquidity from the system in the situation of shortages and access. The repo, reverse repo, term repo auction, overnight variable rate repo auction, overnight variable rate reverse repo auction are the components of LAF. Open market operations. It refers to buying and selling of government securities by RBI in the money market. Both the purchase and sale of these securities may lead to expansion and contraction of the money supply. For example, at the time of inflation, RBI sells these securities and banks buy them. When banks buy these securities, then bank credit is directed away from the public to RBI, which leads to less credit creation and less supply of money in the market. Market Stabilization Scheme. In 2004, the scheme of RBI was launched in order to withdraw excess liquidity from the market by selling government bonds. The problem of excess liquidity was due to RBI purchase of foreign currency. The bonds which the RBI sells are called Market Stabilization Bonds or MSBs, and they are owned by Government of India. Marginal Standing Facility. It is a facility for banks that can be used in an emergency. Under this facility, scheduled commercial banks can borrow up to 1% of their net demand and time liabilities, that is NDTL, at 100 basis points, which means 1% more than the repo rate for the short term or overnight from RBI. It provides a safety value to banks against unanticipated liquidity shocks. Qualitative methods or selective methods. These methods focus on certain sectors only. By using these methods, RBI can divert the flow of credit from one sector to another. The different qualitative methods used by RBI are credit rationing, consumer credit regulation, increasing margin requirement, moral suasion, direct action, and others. Now we will discuss some of them in this section. Credit rationing. Under this method, RBI controls and regulates the purpose for which credit is granted by banks. The central bank can put a ceiling on the amount of loans that can be advanced to the banks. Consumer credit regulation. This method helps in controlling excess spending by the consumers. RBI can direct banks to fix a minimum percentage of down payment, installment amount, loan duration, etc. Margin requirement. Margin requirement is the difference between the market value of the security which is pledged for taking a loan and the maximum amount of loan which can be disbursed against the security. Moral suasion. RBI requests or persuades commercial banks to behave in a particular manner according to the financial situation of the economy. For example, during inflation, RBI requests commercial banks to restrict bank advances. It is a sort of advice and there is no compulsion by RBI. The effectiveness of this policy depends upon coordination between RBI and commercial banks. Direct action. It refers to the direction and the controls which RBI enforces on particular or all banks in case of default or no adherence to advice of RBI. RBI can reject the request of banks for grants or rediscounting facilities, or it may levy penal rate of interest on loans that banks borrow beyond the prescribed limit. Scheduled banks in India. Scheduled banks are those banks that are included in the second schedule of the RBI Act 1934. These banks need to have paid up capital and reserves of not less than Rs 5 lakhs. These also need to maintain CRR balance with RBI, and they can raise debts and loans from RBI at the bank rate. Scheduled commercial banks are further classified as public sector banks, State Bank of India and its associates, old and new private sector banks, and foreign banks. Public sector banks or PSBs. PSBs are those banks in which more than 50% of shares are held by the Government of India. These are the major types of banks in India. At present, there are 12 PSBs, namely SBI, Bank of Baroda, Bank of India, Punjab National Bank, Indian Overseas Bank, Punjab and Sindh Bank, Indian Bank, UCO Bank, Bank of Maharashtra, Central Bank of India, Canara Bank, and Union Bank of India. SBI and its associates. SBI is the biggest commercial bank in the country with nearly 25% market share and has over 22,000 branches and 58,500 ATMs. SBI came into being on 1st July 1955 when the Government of India passed the State Bank of India Act 1955 by taking over assets and liabilities of the Imperial Bank of India. Imperial Bank of India was formed in 1921 through the amalgamation of three presidency banks, namely Bank of Madras, Bank of Bombay, and Bank of Bengal. At present, SBI is a Fortune 500 company and is headquartered in Mumbai. SBI initially had 7 associates, namely State Bank of Bikaner and Jaipur, Hyderabad, Indore, Mysore, Patiala, Saurashtra, and Travancore. However, in 2008 and 2009, State Bank of Saurashtra and Indore was merged with SBI and the remaining 5 associate banks were merged in 2017. Private sector banks. Private sector banks are those banks in which the majority of the stake is owned by private shareholders. In India, private sector banks are classified as old and new private sector banks. The private banks which were not nationalized in the year 1969 are collectively known as the old private sector banks and include banks such as the Jammu and Kashmir Bank Limited, Lord Krishna Bank Limited, etc. As of April 2021, the number of private sector banks in India was 22. Some of the famous private sector banks are ICICI, HDFC, etc. Foreign banks. Foreign banks are those banks which have headquarters in a different country but has branches in India. As of July 14, 2020, there are 46 foreign banks in India. These banks have to follow rules both of home and host country. Bank of America, Bank of Ceylon, National Australia Bank, BNP Paribas, etc. are some of the foreign banks in India. Regional rural banks. They were established in 1975 to develop the rural economy and creation of additional channel to the cooperative credit structure to enhance the reach of institutional credit for the rural and agriculture sector. There were 43 RRBs as of April 2021. Scheduled cooperative banks. Cooperative banks function on the concept of cooperative credit societies, wherein the members of the society join together to extend a loan to each other at a subsidized rate of interest. Scheduled cooperative banks are of 2 types: scheduled state cooperative banks and scheduled urban cooperative banks. There are 23 scheduled state cooperative banks and 53 scheduled urban cooperative banks. Structure of capital market. In the previous section, we have learnt about the money market, which provides short-term funds to investors for less than 1 year. However, business units and investors need funds for a longer duration also for undertaking business expansion or technology upgrading, and in this regard, they approach the capital market. A capital market is a market for long-term securities or financial instruments having a maturity period of more than 1 year. Capital markets are important for channelizing savings, capital formation, and industrial growth. Capital market comprised of 2 markets, primary market and secondary market. The primary market is also known as the new issue market, that is NIM, where the issuer of the securities, that is shares and bonds, sell the new securities to the investors directly without any intermediaries. Whenever the securities are offered for sale for the first time by the companies, They are called initial public offerings or IPO. IPO is issued to raise capital for funding purpose. Both the companies and government raise funds by the sale of new stocks in the primary market. The secondary market is also known as the stock market. It is a place where shares, bonds, options, etc., which were sold earlier, are sold and purchased. In India, the Bombay Stock Exchange or BSE, National Stock Exchange or NSE are some examples of stock exchanges. The secondary market can be either an auction market or over the counter. In the auction market, trading of securities is done through the stock exchange. In over the counter, the trading is conducted without using the platform of stock exchange. It does not have any physical location and trading is done electronically. Financial instruments. Some of the major financial instruments used in the capital markets are: Number 1. Shares. A share indicates a unit of ownership by the buyer of shares called shareholder or holders of the company. A shareholder has ownership in the company and has voting rights and shares the company profit or loss. The benefit which a shareholder receives out of company profit is called a dividend. Let us understand it with an example. Assume that there is a company known as XYZ Limited and it needs funds of rupees 100 crore for further expansion. For raising this fund, the company will go to the public. This capital of rupees 100 crores is divided into 10 lakh shares of rupees 1000 per share. Now assume that there are two investors A and B and they want to invest in this company, so they will buy some shares. Investor A buys 500 shares and investor B buys 800 shares, so they are investing rupees 5 lakh and rupees 8 lakh in this company and have become the shareholders and will share the profit or loss of the company in the proportion to their holdings. Further, shares are of two types, namely equity shares and preference shares. Number 2. Bonds. Bonds are issued by state and central governments, companies and municipalities to raise money for a variety of projects and activities. They are debt instruments in which the entities borrow the funds for a defined period of time at a variable or fixed rate of interest. It is fixed income security and essentially a loan agreement between a bond issuer and an investor. The bondholders, unlike shareholders, do not have any ownership of the company or have voting rights. Number 3. Debentures. Debentures are also a type of debt instrument which is issued by companies for raising funds, but they are not secured by physical assets or collateral. An investor buys debentures based on the reputation and the creditworthiness of the issuer. The interest rate on debentures is higher than that of bonds. Gilt-edged market. The gilt-edged market refers to the market for government and semi-government securities and is backed by the RBI. Government securities are called gilt-edged, means of the best quality because they are highly liquid and risk-free. Capital market intermediaries. There is a large number of intermediaries in the capital markets. Let's discuss some of them. Number 1. Merchant bankers. Number 1. Merchant bankers. Merchant bankers are intermediaries between the investors and the company. They act as an advisor who advises the entrepreneurs from the stage of the conception of the project till the production begins. SEBI defines merchant bankers as any person who is engaged in the business of issue management, either by arranging for buying, selling or subscribing to securities, or acting as manager, consultant or rendering corporate advisory services in relation to such issue management. Number 2. Underwriters. When a company decides to go public to raise funds, all of its securities may not be fully subscribed by the public, so there is a need for someone who can subscribe to those securities. This work is done by the underwriter, who agrees with the issuer company that he would subscribe to the unsubscribed securities himself or by others. He is paid a fee called underwriting commission for this job. Underwriters can be both institutional, for example IDBI, UTI, or non-institutional. All underwriters need to be registered with SEBI. Number 3. portfolio managers or portfolio management services, that is PMS. Portfolio managers are professionals who enter into a contract with the client to advise or direct or undertake investment decisions on behalf of the client. They are of two types. Number 1, discretionary portfolio managers, and number 2, non-discretionary portfolio managers. When the portfolio manager manages the funds of the client independently according to the needs of the client, they are called discretionary portfolio managers. Whereas non-discretionary portfolio managers manages the funds following the directions of the client. Some of the examples of major portfolio management services in India are Motilal Oswal PMS, Kotak PMS, ICICI Prudential PMS, etc. Number 4. Stockbrokers. A stockbroker is an individual or firm which is an intermediary between an investor and a securities exchange. The stockbroker trades in the stock exchange on the behalf of their clients. In return for their services, they are paid commissions or fees. They handle all the paperwork and maintain records of all transactions, manages their clients' portfolio, and advise the investors on formulating different investment strategies in the dynamic world of financial markets. All stockbrokers are registered with the SEBI. And number 5, regulator of the capital market or SEBI. In India, the capital market is regulated by the Securities and Exchange Board of India, that is SEBI. SEBI was established in 1988 as a non-statutory body, but with the passing of SEBI Act 1992, it was accorded statutory power. The major objectives of SEBI are to protect the interest of investors and development and regulation of stock exchange, to prevent deceitful malpractices, and to regulate and develop a code of conduct for intermediaries such as brokers, underwriters, etc. SEBI performs various functions like registration of stock exchanges, mutual funds, underwriters, brokers and sub-brokers, levies various fees and other charges, promote investor education, audit and inspection of stock exchanges and various intermediaries, prohibits unfair trade practices relating to the securities market and insider trading. Now let's summarize the unit. In this unit, we have discussed the importance of the financial system, whereby it brings the suppliers and the borrowers of funds in the common platform. Further, the important functions and instruments of the money market were discussed. One of the major components of money markets is banks. In India, RBI is the apex bank. It formulates and regulates monetary policy. Monetary policy has two instruments, namely quantitative and qualitative. Quantitative instruments include various policy rates like CRR, repo and reverse repo rate, bank rate, etc., which aims at controlling the quantum of credit. Qualitative methods like model suasion, direct action and others aim at directing the credit flow to a particular sector or to prohibit the credit flow. RBI uses both instruments, but quantitative methods are more visible and easy to administer. In the next section, you developed an understanding of banks and the various functions of the banks, along with the structure of banking in India. The different categories of banks like the public sector, private sector, foreign banks were discussed in detail. In the last section, the working of the capital market was highlighted, with the emphasis on the meaning of capital market, its various instruments, intermediaries and SEBI. You were listening to the audiobook by the School of Management Studies IGNOU for MBA program. Course code MMPC 002 Human Resource Management. Course Coordinator Professor Nayantara Padhi from School of Management Studies IGNOU. Voiceover by Harpreet Kaur. Edited by Jagbandhu Jana. Program assisted by Tarannum Jahan. Program produced by Dr. Manoj Kumar Singh. This program was brought to you by Electronic Media Production Center of Indira Gandhi National Open University.